from now on, anything that's being, you heard it. So anything that's being said from now on will be recorded. So as always, be mindful of what you say. And if anybody wants a copy of this video, one, you can ask us directly, but two, all our ministry meetings, we either have a speaker come and present, an expert in a particular field of finance, or we review a book. And if we are reviewing a book, we will not put that online for copyright reasons. But if we are listening to a speaker, then we will certainly upload that onto the church's website. And you can go to Third Street Bethel AME Church YouTube page, and you will see a link to all the videos that we have recorded, including some previous videos that Gwen made in previous years. You can see those there as well. All right, so we are going to go ahead and get started. Why don't we bow our heads and give a moment of prayer. Dear God, we thank you for bringing us to this moment. Thank you for this gathering. Thank you for our lives. Thank you for the technology that allows us to gather in one place to listen to a good presentation. Bless the speaker, bless everybody that is here on this meeting. Allow something to be said, allow us to hear something that not only benefits our lives and our personal finances and the stewardship of our money, but allows us to go out into the community and so that others may derive the benefit of that. We ask many things from you, but we know that you are able to bring many things to us. It's in your son, Jesus' name, we do pray. Amen.
Amen.
It is an honor for us to once again bring to everybody through this platform Ms. Gwendolyn Carney. As everybody knows, Gwen is a member of Third Street Bethel AME Church. She's a certified public accountant, and she's a dynamic presenter who keeps it straight, tells it like it is, and she always gives a good presentation. So whenever she speaks, we have a full house online, and we're so blessed by her ministry and her professionalism. So without further ado, because I think everybody on this call knows Gwen, knows of her, has heard her speak before. I'm not going to sit there and go through her bio and everything else. But I want to present again Ms. Gwendolyn Carney and James Carney, her husband, somewhere in the background. So she's in the husband club, so I'm gonna give out a shout out to James back there as well. All right, Gwen, thank you.
Good morning, everyone. First of all, thank you for taking the time out to spend with me this day so that you can learn a little something about what the IRS and what the state of Virginia has in store for you. I am Gwen Carney. I have been doing this a long time as far as accounting, taxes, and all that good stuff. But my disclaimer always is that no one person knows everything there is to know about taxes. The tax code is so intense, it's so broad that no one person has it to their memory. We are asked questions all the time, and sometimes we have to research the answer because, honest to goodness, sometimes you can call the IRS and get a different answer, depends on who you talk to. So a lot of it is not quite straight. But I will do the best I can. If you have a question as I am speaking, feel free to put it into the chat. I'm sure the Johnsons will let me know when there is a question, and we will try to answer. If I cannot answer it, I will say so, and then lead you hopefully to where you can get the answer. Before I dive into this particular tax season, I thought it would be a good idea to refresh your memory on some things that I had already discussed at other workshops I've done, so that you will be in tune to where we go from here. So I'm about to share a document. I gotta click it, wait a minute. So I'm getting ready to share a document, and please let me know if you can see this document. It should say, here we go again, tax tips for preparing 2024 taxes. Okay, so I'm going to want to refresh your memory Okay, I gotta go down here first. Where is it, Jane? Oh, there you go. I got it. So let's refresh your memory. The first thing is that every year, um, the standard deduction keeps increasing. And therefore, there are people who used to be able to itemize who are no longer able to itemize. But later on in this presentation, I'm actually going to prove to you that there are situations where it would make sense to do your best to itemize, because if you don't, you're going to end up paying the IRS more money than what you should have to pay. But I'll be able to prove it in a little while. The next thing we should remember is that we used to be able to take off personal exemptions for everybody you put on your tax return. It could be your parents, it could be your kids, it could be your cousin you're taking care of. You used to get $4,000 per person that was on that return as an exemption. They have eliminated exemptions. So it don't matter how many kids or parents or anything else you have, you will not get a personal exemption for each one anymore. It's not, it doesn't exist. The other thing we need to remember is that there's a section on itemized deductions, and this is my pet peeve. I actually have a problem with this one big time, because there are a lot of people who itemize, but when you get to the section that speaks on deducting things like your real estate taxes, the taxes that were taken out of your paycheck, even the taxes you pay on your vehicle. When you add those three numbers together, plus you could have been paying taxes on a second house. You might have a vacation home that you're paying real estate taxes on. You might be paying taxes on land. Whatever the case may be, they limit that figure to 10,000. Well, someone making good money, your state taxes alone coming out your paycheck is going to take you to the $10,000 mark. So you're not even going to be able to take off your real estate taxes whatsoever. You're not going to be able to take off the personal taxes on your vehicle, because once you have given the government, once you show that you have had taxes withheld of at least $10,000, it's a moot point. You're not taking off anything else. But back in the day, we used to be able to take off all of that. And it made a difference, especially for the middle class, to be able to still deduct all the taxes that they have paid. So that's a big one that I'm hoping that one day they get that together and fix it, because that is one of the biggest problems of itemizing deductions. It keeps people from being able to itemize who would have otherwise been able to do so, because of that $10,000 limit when it comes to taxes. The next thing is that they have eliminated miscellaneous deductions that were subjected to 2% of your adjusted gross income. So, you know, one time we used to be able to take off, say, employee business expense. You could have been driving for your job and not get reimbursed. You used to be able to take that off, providing the expense exceeded 2% of your income. But now it's not deductible. Neither are tax preparer fees. We're no longer deductible. You used to be able to deduct safe deposit box. It's no longer deductible. So I needed to just refresh your memory on these types of things so that you would know going forward that this is where we are. So the deadline right now this year is still April the 15th. Usually every year it is April the 15th. Sometimes it changes based on what day of the week April the 15th falls on, but it's April the 15th. Now, if you ask for an extension, of course, some of us need to ask for extensions. That doesn't mean you have an extension of time to pay. The government wants their money. And if you're one of those people that always owes at the end of the day, personally, I wouldn't want to know on April 15th what I owed. I would really like to know that on February 1st. So I can prepare to pay them on April 15th. I don't want to hear about it on April 15th. I really need to know this ahead of time. So it's always good to kind of guesstimate. If you can't do the paperwork, at least guess at what you think by looking at previous years, what your situation is, and go ahead and give it to the government. But the smartest ones are those who go ahead online and download the form called 1040 ES. So the 1040 ES means that you estimate that you owe the government X amount of dollars. So that estimated tax form, the deadline for it is actually January the 15th. So if you go ahead and give the government their money by January the 15th, you have saved yourself some penalty because you're not going to get penalized because you did your paperwork late. You're going to get penalized because they didn't have any money. It has nothing to do with the paperwork. It's the money that they want. So I'm telling you that if you make sure that they have their money by January the 15th by going online to irs.gov and download that 1040 ES form for the fourth quarter and go ahead and send in the money. You can go online and pay in advance as well. Let them have their money by January 15th. That will save you money in the end because you're going to get penalized with some more interest if you wait until April the 15th and you determine that you owe some money. That's just a heads up. And I hopefully, this is not anyone that I'm talking to right now, but hopefully no one has any overdue debts to the state of Virginia or for child support or for student loans you done got behind on, because if you are getting a refund from the federal government, they are going to keep it. They are going to keep it and apply it to those types of debts. So hopefully I don't have anyone on here in that situation, but I thought I would let you know that such a thing does exist, that they can hold your federal tax refund. You must be able to itemize deductions in order to deduct charitable contributions. That is a very big one because they call themselves, and I say they, I'm speaking on the IRS. The IRS called themselves helping us out a couple years ago. And what they did was they said, if you did not itemize, but you donated at least $300 to a charity, we will allow you to reduce your income by that $300. And they did it only for 1 year. And then they took it away. So now they got people now who are stuck having to use a standard deduction to arrive at taxable income. And so people who are itemizing, but they're giving away money, if you are giving away enough to itemize, the contribution counts. But if you're not giving enough away to itemize, it's not going to count. But we are allowed to give away 60% of our income and it be deductible. Now, I haven't met anyone yet, including myself, that has given away 60% of their income because that is quite a bit. That, I mean, I know the Lord asked for 10%, but 60% is really, really overdoing it. Okay. I'm just saying. So most people are not deducting 60%, but I get the question all the time because I fuss when I have folks that don't use the benefit of cleaning out their closets. See, we think contributions means checks we have written, cash deposits we have given away to nonprofits and gotten a receipt. But contributions also means cleaning out your closet and taking it to Goodwill, cleaning out your closet and giving it to Salvation Army. You understand? Cleaning out your closet and helping out Habitat for Humanity. That is what we're talking about. So those types of things get valued. And if you don't know it by now, because every time I do this workshop, I tell you, there is a website that's entitled It's Deductible, itsdeductible.com. It is owned by Intuit and it is free to join. And what you do is you join It's Deductible, and every time you go to Goodwill or every time you give something to Salvation Army or whatever the case may be, you go online and you tell it what you have given away. And it gives you an estimated value of what you have given away. So you don't have to do the math. You don't have to even do the thought process. It just needs to know, was it in excellent condition? Was it in poor condition? What condition was it in? And let it value it for you. You will be surprised how much it adds up to be, so that you will have a deduction to go on Schedule A if you can itemize. I'm just telling you that it's not always cash. You also can clean out the closet. Do I have any questions so far before I move on? Okay, I'm moving on.
I
There are
was going to
still,
say just
yes, go ahead, Alberta.
that it's deductible.com is really, really a great website. It really does add up. You know, you put a blouse in there and you think it's $2 and they say $7. But if you put 10 of them in there, you got $70. So it's really a good website. You know, my sister's on my case all the time.
I sure am. Thank you, Bert. So the next item I want to talk about are the tax brackets. The individual tax brackets, there are 7 of them. They range from 10% to 37%, depending on your income and your filing status. Now, later on, hopefully everyone has some paper and pencil, because we're going to do an exercise. I'm not joking, just to show you that just a little bit of being creative. I'm not going to say too creative, but creative enough that we can change our tax bracket. Because let me define for you what tax bracket means. It means that at the end of the day, it doesn't matter how much we make. What matters is how much of it is taxable. So let's start with this. You could be a millionaire. You could be someone that makes $150,000. But at the end of the day, if you can itemize off 50 of it, then you're only paying taxes on 100. You can make $150,000, but if you can't itemize but 30,000, right, then you're going to pay taxes on 120. There's a possibility that someone with $120,000 is going to pay more taxes, of course, than someone with only 100. But the point of the matter is that we have to reduce our income by as much as possible so that our tax bracket is lower. So the lower we get our income, the lower the tax bracket. But I'm going to prove it to you in a minute, in a couple of minutes. I'm going to prove it to you. So the standard deduction has increased, and I'm going to show you a chart in a few minutes that shows you that the standard deduction has increased, and therefore some of us can't itemize because we can't meet that threshold. But if you can't itemize for the federal government, you also are not allowed to itemize for the state. And that makes a difference too. When I show you the standard deduction for the state, it is nowhere near the same figures as the federal government. The federal government is more lenient. The state of Virginia is not. So because they're not, I'm hoping that you're able to at least itemize your federal, because if you itemize your federal, then you can also itemize your state. And that's very important. Next, those of you who have children, if your child is under the age of 17, at the end of 2024, then you can take off $2,000 per qualifying child. Now, a credit is better than a deduction. This is not a deduction. This is truly a credit. So a credit works this way. Once you get yourself down to your taxable income, then we compute what your taxes are. And let's just say your taxes are $10,000. Then the government says, well, we're going to reduce your taxes of $10,000 down by $2,000 for every child. So if you have 2 children, that $10,000 now goes down to $6,000. They're going to take $4,000 off your bill. That is a better way of reducing your liability, is to have a credit than it is to have a deduction, because a deduction just reduces income. This credit actually goes against truly what your bill was to the IRS. A big difference. And lastly, some of you who have those side, I call this a side hustler or online selling business where you're using PayPal, you're using Venmo, you're using eBay because you're selling stuff. Now, everyone's not selling stuff, okay? I get that because sometimes we collect money from people because somebody owed me some money and they gave it to me through PayPal. But now those companies are required, they're considered third-party companies. They are now required to give you what's called a 1099-K if you have collected $5,000 or more through their instrument. Through that party, if you collected $5,000 or more, expect to receive a 1099-K. And so you will have to research that as with the IRS. There are ways to get around not having to pay taxes on it, but the IRS assumes that you're in business, making money on the side when you use those third parties to collect the money. I'm just telling you. I can't sit here and give you advice on, everyone's situation. All I know is that it used to be as high as 20,000. So starting for 2024, they lowered it to 5,000. That these 1099-Ks will be issued because you use a third party for some purpose. And they think the purpose is because you got a side business going on. Now, there are some who legit, they do have it. I mean, I got a couple that I do taxes for that sell sneakers on the internet. They sell sneakers, they sell t-shirts, they sell stuff like that, and they collect their money through PayPal. So yes, they're going to pay taxes on that. But then some people might have loaned somebody $6,000 and give my money back, and they gave it back to you through PayPal. Lord mercy, PayPal think you got a business. You didn't have a business. Somebody was giving you back your money that you loaned. So there's got to be ways to be able to eliminate that. I'm just pre-warning that that's the new thing for 2024 are the 1099-Ks. Okay, any questions before we get ready to get into some work now? And all I ask is that if you have paper and pencil, it would be smart because I'm going to take you through a test after. I'm going to take you through a scenario. Let's put it that way. I'm going to take you through a couple scenarios after I show you the next couple of slides. Do I have any questions before I get into those slides? Not hearing any, get prepared. Here we go. I need you to see these 7 tax brackets. And I don't expect you to memorize them because what's going to happen is I'm going to flip back and forth through them to prove my point. But the biggest one I really need you to pay attention to, and if you want to write this one down, it will be very helpful for you when we get ready to do the possible tax situations, and that's this one. I need you to look at that line that says tax rate of 12%. And I need you to record down that if you're a single person and your taxable income is $47,150, I'm just saying, $47,150, I need you to remember, you only pay 12% if your income is $47,150. But look at here. If your income is $47,151, just one more dollar, you're about to pay 10% more in tax. Your taxes jump to 22%. And it's not just for single people. I'm getting ready to do all of them, but I need you to pay attention. $47,150 is 12%. So if I can get your income down to $47,150 for a single person, I'm going to pay, that person is going to pay less tax than if they had their income is $47,151. No joke. Now, I need you to slide over to married filing jointly. 12%. If I can get your income down to $94,300, you're only going to pay 12%. But if it's $94,301 and up, you're about to jump up. You see that 22%. So this is where I'm going to focus in a minute on just these two numbers, the 12% and the 22%. because they are the biggest difference. If you fall anywhere near those numbers, this one is going to be amazing. The next thing you need to see, I'm going to my next chart. And I need you to see that the federal government has come up with the new standard deductions for 2024. So if you are single, the first $14,600 that you bring in will not be taxed. $14,600 will not be taxed. But if you're married, $29,200 will not be taxed. So let's think about this. That means that a single person has to have deductions of more than $14,600 in order to itemize. Married couples must have more than $29,200 in order to itemize. If you think about it, it almost appears unreachable, but it is reachable, providing you got a couple things going on, and I'm going to prove it in a minute. One of the reasons why this is reachable as far as being able to itemize versus being stuck with using the standard deduction is because if you have a mortgage, the average person is paying, if you're paying a mortgage, the average person's mortgage interest is a good $1,000 a month, if not more. That's average. In today's time, that's average. That means you might have a mortgage payment of about $1,400-1,500. We got people with mortgage payments of $3,000. What I'm saying is that most likely, if you have a mortgage, you're paying at least $12,000 a year in mortgage interest, if not more. And if you have a mortgage, and even if you don't, you're still paying real estate taxes. And if you're not in that situation, the only other thing I can tell you is either you need to get to donating to your nonprofits, whether it's church or whether you clean out the closet. You need to do contributions. That is how you get over the itemized deductions. So I need y'all to also write down this figure. 14,600 for single is the standard deduction. And I need you to write down that 29,200 is the married couple's deduction for standard. And now I'm going to show you and prove to you my case. Now, hopefully everybody's ready because I'm about to hit it. Okay, here we go. So on your paper, I need you to write down the following. I'm going to mess with married folk first, and then I'll get to the single, okay? I need to mess with married folk first. Okay, so I'm going to pretend, let's just pretend that we have a married couple. I'm going to say they're 54, 55. I'm just choosing that age group because I don't want to get up into my 65 and older because they got a whole nother situation. So let me stay at my 54, 55-year-old couple. And let's pretend that their gross income for the year was $130,000. So I need you to write down $130,000 for this married couple. Write down $130,000. And from that $130,000, I need you to take away the standard deduction that you see right here of $29,200. If you take away that standard deduction, you will see that they have a taxable income of $100,800. All right, so that's $130,000 minus $29,200 leaves taxable income of $100,800. Now, I want to take that same married couple. I'm going to start them off again. Go to the right of your paper, and now let's start with $130,000 again for this same married couple. But this time, I want us to itemize deductions. I want us to itemize deductions to the tune of $36,000. So instead of 29,200, I want to deduct 36,000. Now I'm only talking deducting $6,800 more, but it's gonna make a big difference in a minute. I need you to deduct $36,000 from that 130,000, and now their taxable income is 94,000. Okay, so let me show you my point. For the married couple that only use the standard deduction, and I told you that their taxable income was 100,800. The married couple, on the married couple here, you'll see they got to pay a 22% tax bracket. They are in the 22% tax bracket because their taxable income is 100,800. Everyone with me? I'm sorry. Yeah, they're in that 22% tax bracket. But the ones that itemized are 94,000 and take it up, they only pay 12%. So just imagine paying 22% tax liability versus 12%. That is a big difference. As a matter of fact, if I take 100,800 times 22%, the taxes are 22,176. But if I take 94,000 times 12%, those taxes are only 11,280. Well, why would you give the federal government an additional $10,896? And I just showed you that if you had just itemized 6,800 more, you wouldn't have that kind of bill. Let's think about that. That doesn't even make sense. That you would not give away $6,800 more so you can itemize and keep from giving the government $10,896. Which one would you rather do? Would you rather give the government $11,000 or give charity $6,800? Because that's exactly what it boils down to. Either you're going to give it to charity or you're going to give it to IRS. It's one or the other. Okay? Now I'm going to take you back to my single person. And let's do the single person. I'm going to pretend this single person made $70,000. And I'm also going to pretend that they're going to file the standard deduction. The standard deduction is 14,600. So if I take $70,000, I subtract 14,600 from it, then they have taxable income of 55,400. 70,000 minus 14,600 gives them 55,400. But if I take that same person of $70,000 and instead of giving away 14,600, I'm going to get them to itemize 22,900, and I'm going to show you how in a minute. But let's just pretend I can get them to itemize 22,900. Now I know that's $8,300 more, but I'm gonna prove it to you in a minute. So let's just pretend that we take 70,000, we subtract out 22,900, and now their taxable income is 47,100. I'm going back to this sheet. So a single person. My first scenario, I said to you, the single person made 55,400 using the standard deduction. They are paying 22% in tax because it runs between this 47,151 and the 100,000. So they're going to pay 22%. But this young person that actually, I'm not going to call him young, but this single person that actually was able to itemize 22,900, their income is only 47,100, and their tax bracket is only 12%. So when you do the math for them, it's like, why would you give the government 22%? when you could have only given them 12. We're in the same situation. So I just want to give y'all some ideas on ways to itemize. I remember telling you that most people who have mortgages, if you are paying between $11,000 and $13,000 a year just in mortgage interest alone, and when you take that and add to it taxes that came out your paycheck, real estate taxes on your house, taxes on your vehicle, you're allowed to take off another $10,000. And then it's a matter of making your contributions. And you need to make your contributions well enough, big enough, so that you keep yourself in the lower tax bracket, if at all possible. Do I have any questions on that scenario?
Yeah, Tony has a question.
Yes.
What about timeshare?
Okay, so timeshares, because there's two factors to a timeshare. So one is some people have timeshares and they have used they're paying an interest, they're paying a mortgage on that timeshare. Some people are. So most mortgage companies and the way that mortgage works, that mortgage interest should be taxable because that's considered a second home. But the other part about timeshares is also they pay a maintenance fee. But embedded in that maintenance fee is real estate taxes. And you will have to find out from your particular company how much of that maintenance fee represents real estate tax. Now, trust me, it's not a lot. It really is not a lot. I'm only, you might be talking $100 or some dollars. In some cases, it's not even that high. Because that real estate taxes is shared by the thousands of folk that own that same property because it is a timeshare. So you cannot deduct maintenance fees unless you are renting it. If it's a rental property, it's a different story. But if it's not, a rental property is for your own benefit, you will not deduct maintenance fee, but you can deduct the real estate tax. Yes.
All right, I'll have that thing for you then. Thank you.
You will.
Hey, Gwen.
Yes.
Hey, Gwen, Betty Brown in the chat, she asked, can you explain why someone would file head of household?
Okay. So someone can file head of household because they are single and they have a child, a dependent child. So you know how married couples and then some married couples end in divorce, or some single folks never get married and they have a child. That is the definition of head of household. I know we all think that we are head of our household, but that ain't how the IRS definition is, okay? The head of household means that you are single with a child as your dependent. Now, what some people don't know is that if you have your grown child, if you're single and you have your grown child still living in your house, but you cannot claim them on your tax return, you still are eligible for the head of household tax rate by saying my child still lives with me, even though I can't claim them, but I can claim use of the head of household rate, which is a better rate than the single rate. But that rate ain't even available to married couples. It is only available to single with a child that lives at their house. So married couples, if your grown kids are still there, put them out. They ain't no benefit. Not this play. I just play. Any more questions?
Get them out.
I do have a question. Is there an age limit on the age of the child that's living in your home?
For the head of household?
Yes, ma'am.
Okay, so head of household, what happens is your kids, we're allowed to claim our kids until as long as they're in college. So they graduate from high school and then they go do 4 years of college. We still could claim head of household because we could still claim our child on the tax return. After that, the only way I saw that you could still claim your child for life is if that child has a mental issue, is disabled, there are rules that allow for the fact that no age matters. But when it comes to a grown child living in your house and they're not your dependent, then you could claim a head of household as long as they're in your house. It does not matter their age, as long as you're not claiming them as a dependent, but you're only claiming that you want to use the head of household rate. And
Okay.
that tax preparers know that. You can tell a tax preparer, my child still lives here, but I'm not claiming them. So if the child still lives there, but you're not claiming them, you still are head of household as far as your tax rate, but you're not claiming the child. Did I make myself clear?
Yeah. The other question is, what if they're in grad school and you're helping them and they're in your house?
Yes, and I've seen grad school kids get claimed as well. See, what it boils down to is that child making money as well? Is that child out there working as well? That's the determining factor, because someone being claimed cannot claim themselves when they file their tax return, because you can only be claimed on one return. You either claim yourself or your parent claim you or somebody else is claiming you. You can only be claimed once. So it all depends. If that graduate student is also working a full-time job, then it's going to be hard fetched to claim them, because then their tax return will be terrible. It all depends. Any other questions? My next subject is earned income credit. And I just wanted to show you the bracket so you will see that you actually don't have to have any children to be able to get a credit. If you are single and your income is only $18,591, but you got to be 25 years old, you have to be at least 25 years old to claim earned income credit. But you cannot be any more than 65 years old either to claim it. So you have no children, you can get a credit of $632. And you see, if you have one child and you're single, but your earned income credit, your income is only $49,084. And this is earned income now. This is not taxable income. This is not after you done reduced all your stuff down. No, this is the beginning. This is the gross figure. So if your W-2 has more than, if you got one child and your W-2 got more than $49,084, then forget it, because you're not going to get earned income credit. It's for a single person that makes less than the $49,084. Okay, everyone understand that? That's how this chart works. And then it goes on and on based on how many kids you have. I don't know if there's a limit to the kids, because the chart says 3 or more. But I don't know if they give any more than $7,830 credit towards earned income. Does anyone have any questions on this particular chart?
Well, Gwen, not on the chart, but RE asked in the chat, how much can a college student earn without having to file taxes?
A college student earn without having to file taxes? Okay,
Right.
so the way that works is that the standard deduction is for a single person is 14 whatever. So that means that if they're being claimed by their parents, they need to make way less than that, so that when they file their taxes, they can say, oh, well, I'm being claimed by my parent, and give me all my money back. So let me just give you a situation, because I can't help it. It's just who I am. But it makes absolutely no sense to me. If you know, if we know our children are going to still be claimed by us on our tax return, then when they went to go work for that employer, they could have filled out their W-4 saying that they were exempt. Why in God's name would we let the government take money to ask for it back? Because it's going to come back, because the only way you can get it back is you got to ask for it. Now, if you don't ask for it, I give you a good example. I've got a child, parents, I got a child, this child only made like $3,000 for the year, and they're being claimed by the parent. and the government took $50 out in federal, they took $15 out in state, that's $65. Now, but why you gonna pay me to get back $65? It just doesn't make sense that you would pay me to get you $65 when you could have filed exempt and they would have never taken the $65 because there was no reason to. So I think we have to look and see how much is this child making. And if they're only making a few $1,000s, no, they're not gonna have to pay tax. So don't let them pay into it. Let them file exempt on their W-4s.
Hey Gwen, is there
Yeah.
is there somewhere where we can do that research? Because I know for me, even with my kids, it was always difficult for me to explain the W-2s to them, how to set it up when they were my dependents. So where as parents can we go to further our knowledge about how to tell our kids to set it up? Because that is so confusing. Even now, I get confused with a new job filling out W-2s with all the changes.
Yes. So there's on the IRS.gov website, there is a W-4, and it's a W-4, Brenda. That's there. And it also has instructions for it. They changed that form now because now they changed it so that they only want to know, do you yourself have any kids that you're going to claim? That's all they want to know now. What's your marital status? If your marital status is single, you're single. And if you don't show that you have any kids, you're going to get taxed at the single rate. They ain't a thing else you got to say, because they're going to tax you at the single rate because you yourself don't have any kids. But if you have kids, they make you put down $2,000 or $4,000 per kid, so that whoever's preparing your payroll taxes will tell the system, hey, this person has 2 kids. So now adjust their taxes that are coming out of their paycheck, because they need to bring home more money now, not later. Because the point of the whole thing is that we want to break even with the government. We actually don't want to owe the government, and we don't want them owing us. They don't give you nothing for your money all year long. You don't want them. Now, some people, I realize, they do it because they think it's a savings account. Well, I don't know any savings. Well, the savings accounts now only make 2 cents. But what I'm saying is that who loans you money? Who loans money for free? You cannot go into a bank and ask to borrow $10 for free. So why are you loaning the government your money all year long just to ask for it back? It just doesn't make any sense to me. I'm sorry, but that is just not staying focused on the fact that you could take that same money and place it somewhere else to make a little bit of something. Or how about not get in debt with something? How about taking that money and paying for something and not be in debt because you have to borrow it? But thank you for that question, Brenda.
Okay,
Anyone
thank
else?
you.
You're welcome.
Hey, Gwen,
Okay.
there's one more question. Patricia
Yeah.
Brown asked in the chat, a single person making $70,000 should have approximately how much federal and state income tax withheld?
Okay, so a single person making 70,000. Okay, so let's put it to you this way. The tax rate, as I explained earlier, is dependent on your tax bracket, on your taxable income. So every $70,000 person is not equal. It all depends on how much of that 70 you can reduce down to taxable income. So that's why I had the example. You have some 70,000 that only reduce their income by the $14,600 of standard deduction. So they're going to pay more taxes than someone else making 70 and they're able to itemize 23,000 because their taxable income will be lower. So there is no exact tax percentage for someone making 70. It all depends on what you got going on as far as are you able to itemize your deductions or are you going to keep the standard? So if you're going to be a standard deduction person, then it looks like you at $70,000, you probably got to have a good 18%. If I had to guess, you had to have a good 18% come out of your tax return, out of your paycheck. If you're someone who itemizes, you probably don't need but a good 10% to come out. It all depends. Hopefully I answered your question, Pat. Any other questions? All right, we're going to go on to the state of Virginia. So the state of Virginia and what you need to know. So this is the bad part. The standard deduction is $8,500 for individuals and married filing separate returns. Standard deduction is only $8,500. But what did I tell you the federal deduction was? The federal deduction was $14,600 for a single person. So obviously the state is not equal. They're not the same as the federal government. So that is why I kept saying, if you're able to itemize, by all means, itemize, because they are taking it away from you if you cannot. Now, if you're married, filing jointly, $17,000 is the standard deduction. But on the federal tax return, married filing jointly was $29,200 was the standard deduction. And that's a big difference. Both of those are big differences. So that's why I kept saying you definitely want to be able to itemize if you can. Now, their filing deadline is May 1st, but your taxes are still due on time by May 1st. But there's also an automatic 6-month extension to file your taxes, but you don't have to apply for it. They just want their money. So make sure they have their money, if at all possible. And then this is for my military persons who have retired or are receiving retirement benefits from the government for military. Youngkin signed into law that this year, the first $30,000 made by a retired military veteran will not be taxed. My only problem, like I said last year, is that they got an age limit still on it, that you got to be 55 years old in order to get that benefit. And next year they're going to raise it to 40,000. But for this year it's 30,000. And that has really made a big difference for some veterans who have filed their tax returns with the state of Virginia. Any questions on this particular chart?
Tony has his hand raised.
Okay, go ahead, Tony.
Is that for active military or retired military or both, or even civil federal employees?
Okay, so that military retired pay is only for those receiving a 1099-R, which is retired pay. So there's no one receiving a W-2 for currently being in the military. This is only for those who are retired and receiving a 1099-R. Okay. All right.
Thank you.
You're welcome. Any other questions? Okay, if you itemize, you must itemize on the federal. If you do, then you must itemize on the state. But they have a few additional deductions if you're unable to itemize on the federal government. There are a few others. So these are it. And it's not all of them. I'm gonna put the third one up here too, so you'll see. So these are the 3 items that I chose to show you. And if you take the time to look at that, you'll see it deals with school teachers. It deals with, and I spoke on this long-term care before, because a lot of us are so into, and this I know this session is on taxes. This session is not on insurance, but honest to goodness, as sure as my name is Gwen, the probability is that we're going to need long-term care before we need death. Think about it. We're going to need someone to take care of us, most likely, before we die. But we're so hung up on making sure we got enough life insurance, I guess, to make everybody rich and happy, instead of just burying us. Instead of using that same money to pay for a policy that will take care of you in the event you need someone to come into the home and take care of you, or you need to go to a assisted living or a group home or even a nursing home. That is what we don't get into, but we need to. But I'm off the subject now. I'm just letting you know that long-term care insurance, the average person cannot deduct medical on the itemized deductions because medical has to exceed 7.5% of your income. So if you make $100,000, your medical bills and premiums need to be over 7,500, and only that portion that's over the 7,500 becomes deductible. So what the state does, it says, well, if you did pay premiums for long-term care insurance, then we're going to let you deduct it on your tax return to the state. So that's a benefit for those who are unable to deduct it on their federal. You can deduct it on your state. And then they also provide the 20% of sales tax paid. Now, don't confuse that with, okay, I done spent $5,000 on a air conditioner, and now the air conditioner, I paid $250 in tax. They only gonna give you 20% of the 250, okay? They ain't giving you 20% of the 5,000 you paid on the air conditioner. It's 20% of the sales tax paid, right? And it's only up to $500 per person. So those are three of the items that the state of Virginia is giving. Does anyone have any question before I go to my next slide?
Question.
Yes.
I don't mean to be a pest, Gwen, but I gotta
You're
ask
not
a
being a
question.
pest, Tony. Go ahead.
Okay. Part A. Could you go over part A on that slide?
Sure. The part that deals with unreimbursed. So a lot of times our employers used to pay for us to take classes, for education purposes, and now they have stopped. And so, and I don't know why they stopped. I'm just saying they have stopped, some of them. And so now, if you can show that you had some tuition costs that you were not reimbursed for a license, it says licensed primary or secondary school teacher, then 20% of it is deductible, and this is only on the state return.
Okay.
Okay?
All right.
Any other questions?
Thank you.
You're welcome. Okay, so now this is the part of the state I have a problem with, but I don't work for the state of Virginia, so I don't know how else to convince them that they're not right. But anyway, it goes like this. It does not matter if you're single. It does not matter if you're married. What matters is how much taxable income do you have at the end of the day? So on your tax return, if you have 17,001 or more, regardless of your marital status, you're going to pay $720 plus 5.75% of every dollar over 17,000. It doesn't matter. So a single person is going to pay the same thing as head of household. They're going to pay the same thing as single. All of us pay the same rate on our income. It does not matter. And if you look at that, you'll see the lowest rate being 2%, the highest rate being 5.75%. Any questions on the states? Okay. The next thing about the state, they have what's called Virginia College Savings Plans. And let me tell you, I'm going to make this clear for everyone right now, because I get questions, I get asked this question a lot when I'm preparing taxes. I know that in order to get education credit sometime, it actually depends on your income. That's number one. It depends on the income. Number two, if you have any students, they are getting what's called a 1098-T. 1098-T is the amount of tuition that was paid to the school for the year. And there's a couple blocks that you really need to pay attention to on that 1098-T. The first block is the one at the top that says tuition. It tells you if the tuition says, oh, tuition was $20,000. Let's just pretend. I'm pretending now. Tuition says $20,000. If you go down to probably like block 4 or 5 on the right, there's something that says also scholarships. And if scholarship says 22,000, you don't get a there ain't nothing for you to file, because if your scholarships exceed your tuition, then you're not getting ready to get an education credit because you paid 20,000 in tuition because your scholarships were higher. What happens is we as parents are also paying room and board, but room and board ain't deductible. It never has been. Only tuition has been deductible. And if tuition is being covered by a scholarship, what's the deduction? There is none. And then a lot of people can't even deduct because their incomes won't allow them to deduct. Now, I'm going to give you a little tidbit that I think we, and I don't know who all is on here, but we as a people need to think outside the box more when it comes to our nonprofit agencies. And I'm going to put it to you this way as best as I can. We all know that when you donate to a nonprofit agency, and it can be the church or it can be an agency that we are aware of that's nonprofit, or a foundation, we are allowed to deduct anything we give them on our tax return as an itemized deduction. And we're allowed to give up to 60% of our income, so that shouldn't be an issue for anyone. But what happens is we're not smart enough to understand that why can't these nonprofits open up what's called a scholarship fund, allowing parents to pay into that scholarship fund and designate where the scholarship goes? Because if we designate that we want the scholarship to go to I'm gonna pick VCU. We want $10,000 to go to VCU for Mary Jane's child. And so this nonprofit pays the $10,000 to VCU for Mary Jones' child, and that reduces her bill. In the meantime, the parent, because they're the ones that made the $10,000 contribution, gets to take it off their taxes, but it was used to pay for education. But it doesn't matter that it was used to pay for education. The point is that we're trying to deduct off our income money that was given to a nonprofit. So what we designated it to go to that college. That's helping out our people who would not otherwise be able to deduct tuition on their tax return because their income is too high. The government thinks you make too much, you ought to pay for their tuition. Well, we got to think outside the box. There's another way to pay for that tuition and deduct it. How you think some folk, I ain't gonna call them, but how you think other folks doing it? You know, there's got to be a way to do it. So what this right here that you're looking at is where we can set up, a lot of us are grandparents, and we can set up a way to put money into the college savings fund and be able to reduce our income on the state side, because we can't do it on the federal side, but on the state side, the state says if you put money into one of these accounts up to $4,000, then we can reduce our income by that amount. And that's exactly what this is up here. I just went off tangent telling you about tuition, but I've seen it. I've seen too many couples who can't even deduct tuition because their income is too high to deduct it. Do I have any questions on the college savings funds? These are suggestions on steps now to get ready to file your taxes and to avoid processing deadlines, as far as the kind of information you need to pull together so that you can do it. Now, I'll be the first to say that because I do a lot of tax returns, my favorite customers are the ones that come so organized. They come with their stuff already laid out for me. I have nothing to worry about because it's all there. What happens though is when if you're one of those, I don't want to call them, if you're one of those customers that takes an envelope and just throws envelopes in it for your tax preparer, and you never even looked inside the envelope to see what it is you turn over to the tax preparer, I can honestly say, sitting here talking to you, that I have received envelopes with checks in them because it was a dividend. It was their dividend check to pay them back that they didn't even know they had, because they didn't even open up their own mail. They gave it to me because they thought I needed to handle all things because it came from Fidelity Investments. Guess what? You need to look at your own mail first and organize it in such a way that you know what you're turning over to your accountant to do your taxes. I can't do nothing with your check. I got to now figure out, when I give you back your package, how to hand you back the check. So I'm just saying, this is telling you, gather your information in such a way that it is understood. Do your homework. As a matter of fact, I had someone yesterday that I had to say to them, well, did you go through your checkbook to add up your contributions? You know, because we could have made a $25 one here, we could have made a $40 one here, and most of us only get acknowledgments if we have made a $250 donation or more. But we're allowed to take off a donation that we can prove we paid by check. Our checks do count. It's nice that we have an acknowledgement to support it, but our checks also count. So go through your checkbook and don't just, if you're going to write them down, that's fine, but can you at least add them up? You know, you write them down and hand it over to the accountant, you add them up. No, I ain't supposed to add them up. You're supposed to tell me what were your total contributions. Yeah, I ain't supposed to sit here and add up your, matter of fact, I had to tell somebody the other day, I'm charging you for making me open your envelopes. I shouldn't have to open your envelopes. Are you serious? They didn't even use the letter opener so I can just reach in the envelope and pull it out. I literally had to open the envelope. Okay? So I'm just saying, it would be so good if you're organized to help your accountant do your taxes for you. It would be much appreciated. And I do suggest that you file electronically. I also suggest that you have your refunds placed into your bank deposit, into your bank account. But I also get the question, well, what about if I owe? And my answer to that is, if you have the money to pay it. because it gets worse each day. I'm going to give you a horror story and I'll be through. The horror story is this. I have someone who I had to file their 2022, not 2024. I just filed their 2022 tax return a month ago. And that tax return, they owed the government 88. I'm not exaggerating. They owed them 88,000. 88. When you owe that kind of money, they won't let you electronically file. So I can tell you that right now. You ain't electronically filing nothing owing the government 88. It said mail it in. So we mailed it in. And this person went online and paid the 88,000 directly out of their bank account so that by the time they got it, they would have the money. 2 weeks later, the IRS actually wrote them thanking them for the 88 and asked for 55 more. The reason why they asked for 55 more, because 35 of it was a penalty because they had not filed their taxes for 22, which was due in April of 23. We're sitting 2 years later almost. They charged them 35,000 penalty and 20,000 more in interest. So 55,000 was charged in addition to the 88. And the only thing we could ask for an abatement on, because we asked for an abatement, we can only ask for an abatement on the 35,000, the penalty, because they will not abate interest. The IRS is not in them. They're not forgiving when it comes to the interest earned, but they may be forgiving for the penalty. But you got to have a good doggone story as to why they need to let you go, need to remove the penalty. So I'm just here to tell you, if you have the money come April 15th, and you don't want to receive another bill or be in a worse situation, pay it. And then I have some that say, oh, well, just do me a voucher and I'll mail it in. I said, no, I don't believe in mailing in the money. Let them take it out. Well, no, I don't want them taking nothing out from my account. Guess what? They know every account you got. What makes you think? What makes you think the IRS don't already know your accounts? They know your accounts. Guess what? They know more than you think they know. They know all your credit card information too, but they most certainly know every bank account you got. So let them take it. So what? It's faster. It's confirmation that you paid it. What happens if the mailman don't deliver? And especially on time. Then that's another issue. Do I have any questions on this particular page? I know, I can't help it. And then I tell you to file early, because if you've been listening to the news, who in their right mind gets rid of internal revenue agents at tax season? That doesn't make any sense and will possibly cause a slowdown. I'm not trying to scare you, but just think outside the box. The longer you wait and you have less people working, the longer it's going to take. If you're getting an earned income credit, it's going to take you a little longer because they got folks that got to look at it before they can release what they call free money. If you have ever needed to check on the status of your return, you can always go online and check at irs.gov, but you also, I have right there that you can download what's called IRS to go. It's an app that you can put on your phone to check on your refund. The only thing you got to know is how much were you supposed to get back and what was your marital status when you filed it. And lastly, I tell people if you don't ever want to be in a predicament, because I know people right now who have to give me what's called a 6-digit code that the IRS gives them every year because their identity was stolen at some time. So once your identity is stolen with the IRS, you can never file a tax return without this 6-digit code. And if you file married, filing jointly, each of y'all get a 6-digit code, a different one. And that code has to be entered into the software before that return can be transmitted, so that they know it's legit. So you can actually opt into that program without even having your identity stolen. Yes, Brenda.
If you get a pin every year and then this particular year you did not get your pin, how do you go about getting your pin? Because there's a lot of craziness right now and a pin hasn't showed up.
I know, right? And I've had people been on the line a couple hours.
Yes.
Yes.
How do you get your pin? It didn't come this year.
And it didn't come this year. Now, maybe you can sign into your account, because you should have an account online as well. And you might be able to sign into your account online and indicate that you are waiting on your PIN number, on your code, 6-digit code. That's the best way I can think of. Because, yeah, it's a mess right now. It sure is, Brenda.
Okay. Thank you, Gwen.
Oh, you're welcome. Any other questions on that? So now, I know you're tired of hearing me talk. I've been talking for over an hour now. Hopefully, someone has learned something that you didn't know before you came on. And if you have any questions, now is the time to ask. And I'll try to answer all that I can. So how do you unshare?
Hey, Gwen,
Yes.
if nobody's asking a question, I do have a question.
Yes, go ahead.
When we give to charitable organizations, whether it's church or anybody else on a regular basis, some of them will give us letters confirming how much we've donated. And not all the time, they're not exactly what we're seeing in our checking account or our books as to how much we've donated. If there's a difference, and it may not be a whole lot, but if there's a difference, would you advise we stick with our books and we have, canceled checks, we have the records to show what we gave, or should we go back to that organization, try to reconcile it, or should we stick with the letter we got from that organization?
Okay, so for me personally, I keep the letter as support, but I actually don't pay any attention. I actually do go through my checkbook and I do a spreadsheet of every dime given. Because you're gonna have things like a good example for us at 3rd Street, besides paying tithes and offering or helping with the mortgage fund or whatever the case may be, we also every year help out with the shoe ministry. And it's not that the shoe ministry, we're donating money. The shoe ministry, we're actually going out buying those shoes, and then we have a receipt for it. And then I add that as a donation, because it is a donation, in my opinion, when I've donated those shoes that I went and bought. They weren't in my closet. I went and bought those shoes. So in my spreadsheet is what I use to come up with total contributions made for the year. But I keep the paperwork from any organization that gives it to me as support. But I see no need in me reconciling. In other words, I'm not getting ready to call up 3rd Street and tell them, oh, you missed something. No, I got it. And the only way it's going to come up to be a question anyway is if I get audited. It's not ever going to be a question if I'm not audited. So that's the point in which I would worry about it if I get audited. Good question.
Eunice has a question.
Yes, Eunice.
Yes, thanks. Hi, Gwen. A couple of sheets back when you were talking about Virginia state taxes, there was the statement about 20% of sales tax paid on certain efficient equipment or appliances. And what are those, what certain items would qualify or would not qualify?
Well, if they have to be energy efficient. So something, we can buy a dishwasher that's energy efficient. We can buy refrigerator that's energy efficient, right? So that's the word they're looking for, that is energy efficient. Okay?
Okay, great. Thank you.
You're welcome.
Gwen, I have a question.
Yes, hey.
When we get when we get statements from our bank about our savings interest income,
Yes.
do we have to report that? Like if it's $500 or $100, is that something we need to report?
And the reason why the answer is yes is because banks, institutions do not issue that report to you if the account has only made less than $10. Once the account has made $10 or more, they report it to the IRS as well. So the IRS knows and is looking to see that same money on your return.
Oh, okay. Thank you.
They got a database with it.
Okay.
Okay,
Thank
good
you.
question. All right. Any more questions?
Gwen,
Question?
Hey, Joanne.
Go ahead.
solar energy. It seems very complicated. Is solar something that I know you were supposed to get deductions for it, but it looks very complicated. Should we request that the agency that installed it give us the amount that we are able to file, or do we have to your experience, do we have to calculate it ourselves?
Oh, no. So what happens is with solar panels, your paperwork shows you how much you pay for those solar panels, and it's only a matter of turning it over to the tax preparer because in our software, we have to indicate how much you pay for the solar panels, and it computes a certain percentage of it as a credit on your tax return. There's nothing for you to calculate. You get, I think it's a 20% credit. You get the credit back on your tax return for that solar.
So
panel.
the document that we received, the amount that we should deduct is included in that package.
Yes, it has to be because the point is that you have got to have an invoice that shows you what were you originally charged for those solar panels. You have to have something because most people finance it. So on that financing agreement, there'd be something that shows you what it costs. Maybe you put something down and then you finance the rest of it. But the answer to the question is there in that package. What did you pay for those solar panels?
Okay, thank you.
Oh, you're welcome. Anyone else?
Yeah, Rolanda asks, her comment in the chat is, good afternoon. Thank you for the information. Very informative. May I have your contact information?
Yes, you can have my contact information. It's better always to call me on my cell phone. And then if I don't answer, leave me a message and I will call you back as soon as I can. And that's because I can't save all my clients in my phone, but I'll have no problem with you actually calling me. So my number is 804-691-1173. So that's 804-691-1173. And just leave a message and I will call you back as soon as I can.
All right, Evelyn Britton says, please send me the video to my email if possible. Thanks. Yes, we will do that. We'll make sure to send you a copy of the email.
Okay.
Not a copy of the email. We'll send you an email, a copy of the video.
Yes. All right. Is there anybody else with any questions? Anything I haven't covered? I know you can't cover everything in the tax law in one setting. You can't even cover it if you talk every day. But anything, if I can help, just holler out and I'll do the best I can.
Well, just one thing, Gwen.
Yes.
If we're looking to come to you for some assistance to be your client, can you give us a rundown on exactly what you want? Because I can tell you're real particular.
Yeah, so when you call me and we talk about your individual situation, I'll be more than happy to tell you what I need.
Yes, ma'am. Thank you.
You're welcome. I just saw a question. Do you see another question? I was giving an answer and I can't remember what it is. You see another question?
Yeah, there's from a cell phone number. It's a number, but it says, can we claim clothes and shoes?
Oh, that's right. Yes. So when I mentioned earlier about the website called It's Deductible, taxdeduct.com. That is where you set up a free account and you indicate what date you took it to wherever. I'm choosing Goodwill. And in there, you indicate what the clothes were. See, where we fall short is that we think we should be able to take a bag of clothes, drop it off at Goodwill, and not have any recollection of what was in the bag. Well, guess what? We need to take an inventory because you have to be convincing. How do you convince anyone that in that bag, what was in the bag? So you say, I gave away 12 pairs of shoes. I gave away 10 pairs of jeans. But you go on to the it's deductible and put that same information in it and it values it for you so that you don't have to worry about what's the total value of that deduction. It's going to do it for you. And you print it off as support for what you gave. The other thing I'll tell people is that I know in the past, and I have done it, that I had so much stuff that I left it all on the floor and I took pictures. Before I ever inventoried and put it in the bags, I took pictures because pictures are worth 1,000 words. I took them pictures and I have them in my tax documents. Yes, this is what I gave away. Now, whether you don't know if I gave it away or not, because you ain't go with me to Goodwill. I get that. Okay. But if I'm trying to be convincing to you, then that's what we call corroborating evidence. You know, we have something to prove it happened or try to prove it happened, right? All right. Any other
Judge
questions?
says that counts as evidence.
Evidence.
Esther Forrest Hines asked that are copies of the videos posted on your church website, not on the website, but if you go to YouTube, and it's the church's YouTube page, Third Street Bethel AME Church, there's some links you can follow and get to our ministry, the personal finance ministry. You will see all of the videos that we have posted online. Again, we just post on YouTube the videos with our speakers. So you'll see historically all the speakers and their presentations there. Also, the cell phone asks another question. Okay, how about casual clothes and shoes we buy for work?
Okay, so clothes that you actually buy for work. The only clothes that used to be deductible for work would have been uniforms. Even pastors can't deduct their clothing because pastors can deduct robes, but not their suits, because you don't only wear the suit when you're in the pulpit. You wear that suit for other things than ministry. So when it came to uniforms, it used to be deductible as a miscellaneous expense under itemized deductions. But earlier in my presentation, I mentioned that they took away the miscellaneous deductions on Schedule A. So if you have a job-related expense, it is no longer deductible. The only ones who are deducting things because they have to dress a certain way for a job are those who are filling out a business form, a Schedule C, which is the profit and loss of a business. If you ain't in business, it's not coming off if you're not in business.
All right, and Evelyn Burton, she followed up, video posted to all church websites? No, not all church websites. And it's not to our church, Third Street Bethel, not to the church website, just to the YouTube page. And Lashara Smith-Scott, actually in the chat, she posted a link to the Third Street Bethel YouTube page. So if you want to hop on the chat and take a note of that link, copy and paste it, then that will take you right to where I was talking about before. Thank you, Lashara.
Thanks, Lashara.
I want to do that.
All right, any other questions for the speaker?
Good questions.
Yes,
Yeah, they were good questions. They are.
And thank you, Gwen.
You're so welcome.
Always a pleasure.
always appreciative of the time that you give
Yeah.
to us and the support that you give to this ministry and the wisdom. And, you know, Zelda and I have, we take notes. We can show you notes we've been taking every year. We take down notes. And, so we are so appreciative of you and James
Save
back
us-
there.
And save us
Yeah.
a lot of money too.
Save you a lot of money too. Yep.
And we know James is a tech guy back there, so we appreciate James as well. So thank you, James. and Thank you for what you do as well. All right,
Yeah.
just by way of updates, our next meeting will be on Saturday, April 26th. Right now, we're looking at 11 a.m., but we may push that back to 1 p.m. depending on some other things that may be going on. So be on the lookout for information. We will be getting back to our study. We began a new book. We completed the book, Tiff Felici's book, Get Good with Money, earlier this year in January. So we started last time with the book Wealth Building Secrets from the Bible. And the author is Jonathan Geraci. I don't know if I'm pronouncing that correctly. It's Geraci. But you can look him up online, see what the book is about, or you can join us. And so what we typically do, for those of you who have not been party to those sessions, we will listen to the Audible book for about half an hour, and then we will have a discussion on what they're talking about. And then we try to do that every other month and have a speaker every other month. So in 2 months, in May, we're looking to have another speaker. We've been in communication with several good speakers. The last speakers we had up till Gwen, we've been talking about long-term care, estate planning. And so we're going to pick back on that up and speaking with a lawyer that we know fairly well who does this type of work, how to prepare for estate planning and also preparing for long-term care, how to get those set up, qualifying for Medicaid, things like that. So I think she's going to be a dynamic presenter, and also somebody we know who can talk about prepaying burial and arrangements, end of life arrangements. So we're going to try to pick up on that theme. So be on the lookout for that in May and further on into summer. All right.
And if you have any other topics that you're interested in hearing about, send us a message, let us know. We can look for speakers for those topics as well.
So you see the question Joanne Knock is asking?
Oh,
What is the name of the book and author of the book?
author of the book.
It's Wealth Building Secrets from the Bible. And the author is Jonathan Geraci, or Geraci, Geraci. All right. Any questions about any of that? All right, so we're going to close out with prayer. Dear God, we again acknowledge your awesomeness. We acknowledge your presence. We thank you for a great speaker and a great presentation. We have definitely learned something, and we want to use it for the betterment of our lives. Bless those who are on this video. Bless everyone who, for whatever reason, could not be here. Bring peace to this world. Bring reassurance to us. Bless our finances so that we can use it for the building of your kingdom. It's in Jesus Christ that we do pray. In his name that we do pray. Amen.
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 Thank you for coming,
Thank you.
everyone.
Thank you.
Thank
all.
you.
Bye.
Gwen, thank you.
You're welcome.
you.
Thank you,
You're
Gwen.
welcome.
Thank you.
You're
Look forward to
That
it.
was great.
See you soon.
Okay, yes, ma'am.
Thanks, Gwen.
You're so welcome, Thelma.
You, Gwen,
You're so welcome.
Alvina.
Alvina.
See you tomorrow. Bye.
See you tomorrow.
Yay.
And don't forget to shut down your recording, Johnson's.
Yes, we need to shut it down. We have to.
Oh, yeah.
I have to do something.
Right. Yes.
What do I have to do?